What's up, guys? In today's video, I'm going to be explaining the wheel options trading strategy. It is one of the best trading strategies out there if you use it correctly. Overall, we have a great video for everyone today, so make sure to stick around to the end, but let's get right into it. So you're going to want to make sure that you have at least a brief understanding of how call and put options work. I know a very common trading strategy out there is an investor might buy a call option for, let's say, $100 and then hope to sell that call option at a later date for maybe $150 or, just for a higher price than they bought it for, and then to profit off of that spread. Now, while that is great, a big problem with that strategy and just like short-term trading is theta. So for example, I'm sure if you've been trading options for long enough, you may have bought a call option and the stock price may have rose, but you still lost money, and that's because of time decay or theta. So basically all options decay in value every day. That's just how they're designed. It's called theta decay, and theta decay is exponential. So while theta actually screws over a lot of options traders, if you use the wheel strategy, you are actually kind of like teaming up with theta, and it's on your side and it works for you. So every single second that passes while you're holding short options, you're profiting off of time decay. Now I'm going to explain that more as we get like deeper into this video. So as long as you have a brief understanding how calls and puts work, if you buy a call, you want the stock price to go up. If you buy a put, you want the stock price to fall. However, the wheel focuses on shorting puts and shorting calls. So for example, one of the first steps with the wheel strategy is you have to short a put option. So let's say Apple is at $100, right? And let's say for easy math, let's say you short the 90 strike put option that expires this week, or this Friday specifically. And let's say you get paid $50 for doing so. No matter what, since you shorted that put option, no matter what, you are going to keep that $50 premium, no matter what. The only contingency is if Apple closes below $90 by your expiration date, you have to buy 100 shares of Apple at $90 each, and that is your strike price. So in simple terms, when you're selling put options, if the stock price closes below your strike price on your expiration date, you have to buy 100 shares at your strike price. So it sounds complex, but it's actually pretty simple. If you need a more in-depth understanding, I highly recommend just like Googling how do cash secured puts work, and that'll solve that for you. But then another aspect of the wheel strategy that you have to understand are covered calls. Basically what happens is, let's say, again with the Apple example, let's say Apple is at $100 and you own 100 shares at $100 each. You might sell a 110 strike call option that expires this Friday, and you might get paid $45 for doing so. No matter what happens, you are going to keep that $45 premium, no matter what. The only contingency is if Apple closes above your strike price on your expiration date, you are going to have to sell your 100 shares of Apple for $110 each, which is your strike price. So when you sell covered calls, no matter what, you keep your premium. The only contingency is if the stock closes above your strike price on your expiration date, you have to sell your shares at that price. So hopefully that explains that pretty well. But let's get more in depth to how the wheel strategy works. So the wheel strategy focuses entirely on theta decay. Like I said earlier in the video, theta screws over so many investors or options traders, I can say, because a lot of times direction isn't even the problem. People will make a successful stock prediction. For example, if we go back to Apple again, let's say Apple's at 100 and someone predicts that Apple is going to rise by this Friday. And let's say that options trader buys the 110 strike call, but Apple only rises to like 109. That options trader made a successful prediction about Apple, but the problem is they didn't get the strike price right. So theta kind of screwed them over, and even though they predicted Apple will go up, and it did go up, they would have still lost money because of time decay with the options. So basically, like I said, wheel focuses on time decay and just like doing it every single week or every single month or however you configure your strategy. So the first thing you want to do, and the most crucial step about the wheel strategy is you have to find a stock that you like for the long term. That is the most important thing. Don't worry about doing this on penny stocks or some crappy stock, right? You want a solid company that you wouldn't mind holding for the long term. That is the most important aspect. Now that stock also has to have options trading enabled. So like a couple of good examples that I like are NIO. I think that's a great example. You could say NIO, Palantir, DraftKings. Those are some pretty good examples. But for today's video, we will be using NIO. So NIO is around $38 each right now. Another thing you might want to make sure of is that the stock price is relatively low, because you might have to buy 100 shares of that stock. So for example, NIO is at $38 right now. Do 38 times 100. That shows how much you will need to use this strategy. So for NIO, you'll need 3,800. If a stock is trading at $15, you'll need 1,500. If a stock is trading at $150, you'll need 15 grand. So keep that in mind. Step number one, find a good quality stock that you would like for the long term. It has to have options trading enabled, and you just have to have enough money to buy at least 100 shares worth of that stock to be able to use the wheel on it. Step two, you have to sell a put option. So the wheel focuses on selling put options on a stock you wouldn't mind holding for the long term. If you're assigned on those put options, you simply buy that stock at your strike price, and then you sell a covered call on it. And then if you're assigned, you repeat step one. So basically, it's all about just capturing time decay. So I'm going to give you an example right now. NIO, it's at $38 each. You might look at NIO right now and you might sell the 34 strike put option that expires in 2 weeks from now, right? And let's just say for simple math, let's say you get paid $50 for doing that. No matter what, you're going to get paid $50 for doing that, no matter what. Now, if NIO closes below your strike price, which is $34 on your expiration date, you simply buy 100 shares of NIO at $34 each. Now, from this point, what you want to do is you will sell a covered call on it. So now you own shares of NIO at $34 each. NIO might be at, I don't know, let's say $33.80, right? What you're going to want to do is you'll go back to the options chain. You might sell a 35 strike call for that expires this week, and you might get paid $30 for doing that, okay? No matter what, you're going to get paid $30. But if NIO is above your strike price, which is $35 by your expiration date, you have to sell your 100 shares of NIO at $35 each. Now, if you get assigned, you simply sell your shares, and that's awesome, and you actually profited 3 different times. One, you profited when you initially sold the call, when you initially sold the put options, so you made 50 bucks. Then you also profited another $30 when you sold the put options, and then on top of that, you made a capital gain. Capital gain. You bought 100 shares at 34, and then you sold 100 shares at 35. So, you make money 3 different ways. So that's kind of how the wheel strategy works, and that's just kind of like the ideal scenario. Now, let's say you sold a put option on NIO, right, for $34, and you bought it at $34, and let's say NIO fell down to 32. You just sell covered calls on it above your strike price. So you'll sell, the NIO 35 strike calls every week until you're assigned. Now, here's the thing. The most important thing is you have to make sure you wouldn't mind holding the shares for the long term. If you're doing this on some crappy penny stock or this way overvalued stock, the strategy isn't going to work. You have to make sure that you're doing it on a stock that you would like to hold for the long term, because technically, like, the only major risk is if you, let's say, sell the 34 put on NIO and it falls down to, 30 and then 25 and then 20, right? You just have to be selling covered calls on that stock every single week to continue to profit off of time decay. Now, if you like the stock for the long term, even if it has a short-term dip, if you like it for the long term, it should be fine to hold. So that's why it's important to do this on like solid companies that you like for the long term. And another question that I expect a lot of people might have is, all right, Mike, let's say you like NIO and right now it's at $38, and I'm going to try this wheel strategy out. What expiration do I choose? What strike price? How do I choose all these expirations and strike prices? And that's a great question, but it's totally up to you. What I like to do is I like to sell put options that expire in 10 days or less. And I'm an active trader in the market, so I'm always always watching everything that's going on. But if you're not, feel free to go out maybe 30 days or less in terms of expiration. Now, here's one thing I do recommend. The further you go out in time, the more money you're going to collect. But a thing to keep in mind is Theta Decay is exponential. So the closer you get to that expiration date, or the closer that option gets to its expiration date, the more it's going to decay. And that's exactly where you want to be, because you profit off of Theta Decay. So you want to be selling that option when it's decaying the most. So I highly recommend, let me say this. Options decay the most in 30 days, in the last 30 days of their expiration. So I highly recommend getting somewhere in that window. Weekly options decay the most, but you won't always get the best premiums for them. So I like to go with options that have around 10 days or less to expiration. That's just my personal opinion. Of course, do your own research and trust your own gut. Another thing in terms of expiration selection, though, is some people like to go at the money. So if NIO is at $38, they might want to sell a 38 strike put, and that can be awesome. You're going to get some great premiums for that, but it is a little risky because you have a decent chance of getting, assigned those shares. And if you really wouldn't mind holding those shares for the long term, there's no problem with that. Personally, and how the wheel is meant to be played is you just want to profit off of time decay. You don't really want to have to deal with shares, but if you structure it correctly, as long as you're using this on a stock that you wouldn't mind holding for the long term, even if you are stuck with shares, it's totally fine. So I like to sell options that have around an 80% chance of expiring out of the money or higher. And if you don't know how to calculate those percentages, Thinkorswim by TD Ameritrade has an awesome platform where you can just plot that automatically on their options chain. But a cool trick is, even if you're on Robinhood, we all know that they're not the most advanced platform, but when you look at the options chain and you select any specific option, you will see values for the Greeks. And the delta value can give you a good idea of the likelihood of that option expiring in the money. So if we go to an option, if you want to have an option that has around an 80% chance of winning, you want to find a put option that has a delta value of negative 0.2 or less. So for example, just take the delta value, times it by 100, and that'll kind of give you like a rough estimate of the likelihood of that option expiring in the money. And then, of course, it has to be a positive number. So if a put option has a delta value of around 20%, that means it has or if it has a delta value of around negative 0.2, that means it has around a 20% chance of expiring in the money. If a put option has a delta value of negative 0.3, it means it has a 30% chance of expiring in the money. So I like to short put options that have a delta value of negative 0.2 or less, because that means they have an 80% chance or more of expiring out of the money. That's just my personal opinion, and that's just what I like to do. Of course, it just depends on your risk tolerance and what your goals are. But to recap, the wheel strategy is amazing because you don't really have to worry about timing exits too much and all that crazy stuff. And if you do it correctly, it is a win-win as long as you're doing it on a stock you like for the long term. Now, here's the thing. It does require some money to use. You can't just have $100 and use this strategy. Like I said, a good rule of thumb is you want to find a stock that you like for the long term and just multiply its current share price by 100, and that'll give you a good idea of how much you'll need to use the strategy. Another thing is there are different advanced ways to use this strategy, like rolling options and different ways to hedge yourself. Really, from what I found, is if you just simply sell put options that don't really have that much time left. I've been selling a lot of put options that expire either this week or next week and that are pretty far out of the money. Just due to the way how the market works, you will win a lot, but it's all about how you manage your risk. So I cannot stress enough how important it is to make sure you're doing this on a stock that you like for the long term. Please don't do this on some crappy penny stock, even if the premiums are great. And my favorite thing about this strategy is time is on your side. Theta Decay, or time, is a lot of options traders like to call it, screws over so many people, and to have it on your side is just amazing. And another thing is, you really don't have to do too much work with this strategy. It's not going to make you rich, but the odds are in your favor. And if you just sell a put option every other week or so, you will be collecting some pretty nice premiums. And in the worst case scenario, you just buy shares of a company that you like for the long term. So I hope this video helped you. I hope I explained it in a simple way. But if you need any additional help, just let me know in the comments down below. And then also, I highly recommend looking at Investopedia.com to learn more about how cash secured puts and covered calls work. They're a great resource and they're free. So definitely check it out. But thank you guys so much for watching today's video. If you guys want to connect with other like-minded traders, you can click the link in the description down below for the free Discord chat. It's completely free, and there's 12 or 13,000 other traders in the chat. It's completely free, and you can ask questions there and get help for free. So definitely check it out. If you guys learned something, don't forget to subscribe. But other than that, thanks for watching.
To the moon!